Yeah, hello everyone. Welcome to DealStreetAsia's latest webinar. Thank you all for joining us. As we have more attendees joining, I'll just take the first couple of minutes to, just introduce the panelists, get across some basic housekeeping points. We have a very interesting topic today. It's about strategies to thrive during a crisis. And I'm joined by two very interesting panelists. I have Sudhir Agarwal, who's the founder and CEO of Everise, and Atul Kapur, who's the co-founder and CIO of private equity firm Everstone Group. Before I introduce the panelists, just a couple of housekeeping points. The Q&A box is active, and if you're an attendee, you can ask questions there. But do add your name and organization too when submitting a question. We'll try and ensure that most of the questions are answered. All those who've already sent in your questions on email or in the form earlier, thank you so much. I have them. We've got them. I will be taking it up during the interaction. The questions that come in during the session, our team will pick up the most relevant ones. We'll try and get them answered. And if there are some that we can't take, we'll send it across to both Sudhir and Atul after the webinar. We'll get them answered, and then we'll post the replies on our website. While the raise hand feature is active on Zoom, we are not using it. And the final point is this webinar is being recorded. So we will be sharing both the transcript and the video with everyone, all the attendees and all our subscribers, readers, early next week. So good. Okay, let me get started and let me begin with a brief introduction to both the panelists. Let me start with Atul. So Atul Kapur is the co-founder of one of the largest private equity firms in this part of the world, Everstone Group. He also serves as the Chief Information Officer for the group. He is based in Singapore, and I guess that before the pandemic, he was shuttling between Everstone's offices across all three continents. But I think the last couple of months, he's been very much only in Singapore. And before founding Everstone in 2006, Atul spent about 12 years at Goldman Sachs, where he was a managing director in the Principal Strategies Group and was based out of London. Interestingly, I think Everstone is among the few, maybe perhaps the only private equity group that does India, Southeast Asia, and even Indonesia together. The firm has over 450 employees across three continents, several $billion when it comes to assets under management. And coming to Sudhir, he's a veteran of the BPO space. He was previously with Genpact and helped set up Aegis in India. And then he shifted to Singapore for his first entrepreneurial venue, which was Sunrise BPO, which later became Everise. At Everise, he's led very aggressive M&A strategies. So there are quite a couple of companies. We'll discuss that during the webinar, which is C3, True Source Labs in the US, Hyperlab in Malaysia. What's particularly interesting is that when you look at Everise, even before the pandemic, they're one of the few firms that were sort of already had or readying a work from home concept. And we will be speaking to both of them in terms of how they handled the last 6 months or more. What are the strategies to thrive through a crisis? And this is a crisis that we know has had a devastating impact on many industries, on the investors and all the plans for the future. So let me start with a more of a big picture question. I think Sudhir, you can go first. Quickly, for the benefit of all our audience, you can just take us through how has it been over the last maybe 6 months?
Thanks, Joji. Thanks to you and your whole team for organizing this webinar. I must really first say that I think this whole pandemic is absolutely very sad, and I think it's affected not every business or every country globally, but it's affected each and every one of us globally. From a business point of view, I think what it's done in our and whatever I'm going to speak about, I'm going to speak to the tech industry and more specific to the outsourcing industry. I think what this pandemic has done is it's kind of separated the men from the boys, if I can say so. we as a company have two philosophies in terms of investments. First, our investment philosophy is people, and second, our philosophy has always been technology. And we've been investing in our work at home platform over the last 2.5 years. And hence, when the pandemic hit us, we were able to move, pretty much 98% of our workforce within a span of a few weeks to work from home globally. And again, it was because of the investments that the team had done. And even while we talk today, we are obviously 100% live, and more than 90% of the people are actually working from home.
Got it. Interesting. Atul, so quickly from your side, because you operate across several different sectors, several industries, several geographies, you invest across multiple stages. How has it been in terms of like for a PE firm the last maybe 6 months or so?
Well, other than it being a groundhog day every day, when you wake up, you have to do the same thing over and over again, as you can't, as everybody's locked down and can't attend offices and can't meet colleagues. I think, it's been, if you just chart the journey, we were in Singapore, we were sort of got whiff of this early in the year, and by February, we were fearing the worst because having experienced SARS, we wanted to be ahead of the curve and not behind the curve. So over these 7 months, Joji, it started from sort of planning in February and March. It was kind of running blind in April because nobody had a clue as to which way the pandemic was going to shape, what the impact on different businesses was likely to be, which companies would require capital and not. So April and pretty much most of May was running blind. I think in June, certain patterns started emerging and you had some sort of visibility that what had happened. And I think April and May was probably the worst. And partly it was because of uncertainty and lockdowns, in multiple geographies, and not just in India, but India, the Philippines, Malaysia, and the United States. Everywhere there was consternation. I think by July, you had some semblance of stability, there was a little more predictability in terms of the trajectory of the businesses. And then in August, I think we had our arms around most issues, and we had, started executing strategies, because as it always happens in situations like this, there are winners and I wouldn't say they're losers, but there are companies that are more impacted and companies that are less impacted. And then there are companies that are positively impacted that can take benefit of the situation that arrives. So I think we quickly sort of sifted. By July, we had a pretty good sense, which buckets businesses would fall in. And therefore, the ones that we think were going to be most impacted took a significant focus of our attention and energy to make sure that those businesses, manage and navigate this period effectively. And I think that's where we are. I think the worst, as far as we're concerned, is behind us. I think it's going to be very rare for entire countries to go into complete lockdowns. This thing will be on, off, but I think companies have also figured out how to navigate this a lot better than they had in February. So, as they say, plans are useless, planning is invaluable. So, as we've had to consistently change our plans, but the planning exercise has been a fabulous one, where at least we can be anticipative of what is likely to come and therefore what our likely responses are going to be.
Interesting. I'll just stick to what you said, Sudhir. Let me just come back to you and just taking what Atul said. You said that you were able to transition about 98% of your, I'm assuming that you have over 12,000 employees across the world, and you were able to take over 98% of them to work from home in such a short period. How was that transition been? How do you do it?
So, very, very good question. Firstly, please understand that, we operate, two of our biggest sectors that we operate is in healthcare and tech. Healthcare and tech probably constitute, over 85% of our customer base. Now, when you're in healthcare, when you're in tech, there is also huge regulations and compliance. Work at home doesn't mean that you can just go work at home, put your laptop on and start working. It doesn't work like that. And that's why a lot of the other companies in our space have struggled and are still struggling. Your entire technology architecture has to be on the cloud. more importantly, it has to be compliant. You have very strict guidelines which our clients lay down. For example, it has to be PCI compliant. There's an HIPAA compliance for healthcare. I won't get more into it, but firstly, your technology architecture has to be secured. Secondly, you also have to ensure that, obviously we have to move a lot of equipment in those 2 weeks to our people's homes, right? Because that's one thing they need. Because, again, we don't, that's standardized, and we had to move a lot of equipment globally to people's home. That's why it took 2 weeks. Otherwise, you have been up in 24 hours, right? And the third is coming up and investing in new technology to also ensure that when our colleagues are working in their house, they're working in a secure environment to again ensure there's compliance. So I think it's investment, Jojo, over the last 2.5 years that we've made in in the area of technology, and which kind of has helped us move all our people to work from home.
Yeah. Sudhir, just
I just like to add there. I think that it's very. I think what Sudhir did as we thought about this about 2 years ago as to what the new Gen CX business should look like, and therefore we started experimenting with work from home, well before the pandemic hit, and that level. And again, I go back to what I said. Planning is invaluable. Plans are useless. So planning, to get the business to transition to a work from home environment started well in advance of the pandemic. And I think that stood us in good stead as the pandemic hit, the level of preparation to get people out to their homes. And then it was just an execution. It wasn't, we weren't running to move everything to the cloud. We were already on the cloud. Then the execution was just getting people enabled to start working from home. So,
yeah. And I think, Atul, the other point, Atul had mentioned this earlier on. I think because we are based in Singapore, we saw the pandemic a little before than the whole world saw. So really, our COVID plans were put in as early as Feb across the globe. So, but again, listen, there is no substitute for planning. The amount of planning we did for this. I mean, just to give an example, I exactly know even today I get how many people actually have COVID in our company and how we support them. So that's the amount of planning, and there's no substitute for that.
Sure. Sudhir, let me just come back to you on two related questions. One is when you're operating across so many different geographies, the situation is very different in each country. And therefore, did you sort of require different strategies for different countries? And the second thing that I wanted to ask you is also because you provide services to clients across different sectors. So did you have to pull in a lot more teams into, let's say, clients who need services in terms of healthcare and tech? Because I'm assuming that those sectors, some of those companies would have needed support, which was far higher than the pre-COVID times.
So your first question, absolutely. You obviously have a global COVID strategy, but then you have to adapt to local needs. And I'll give you an example. Over a weekend, 3 of our countries that we operate in announced lockdown. And when I mean lockdown, I mean complete lockdown. There's Philippines, Malaysia, and Guatemala. Okay. US never announced lockdown, but we just sent everyone to work from home. So we learned from the best practice from those countries, and we implemented it across our 8 sites in the US, and we said, no, go work from home. So absolutely, it was, you have to adapt to local regulations. Today, there are countries that have actually opened up, but we still have people working from home. And our view is, for a long time, till the time a vaccine comes, majority of our people will continue to work from home.
Got it.
On the second point, absolutely, we are in the business of supporting our customers, right? And it's mostly in times of trouble that you need to support them. A few of our clients in certain verticals needed more help, so we deployed more resources and more technology. And then in a few of our clients where we don't have a big exposure, but let's say travel, for example, they did not need that much help, and we helped them by assisting them in that way. So listen, our job is really to assist our customers and we do whatever we can to ensure that we keep their customers happy.
Interesting. Atul, I just want to come to you in terms of just step back a bit. As a private equity firm, Everstone, you sort of have a platform approach in the sense that you often come into some of the companies very early, help them sort of build it out. So first, there was you had Everise under you, and Everstone, then there was Sunrise BPO. I just want to understand the investment philosophy in terms of where what got you interested in this sector, because you hadn't invested here before, and take us through the journey over the last 4 to 5 years.
Sure. So, we had not invested, Joji, in out of the Everstone funds in the BPO sector, but, both the senior management and the teams that we have in their previous lives have had significant exposure to the sector. So, we understand what the economics and the attractiveness of the sector are, but we were struggling to find the right combination of a management team that had a vision that mapped ours, as also an asset that gave us the necessary scale to do what we wanted to do. So in short, we wanted to build a next gen CX business. And we had very specific criteria along the sectors we wanted that CX business to be present in. So healthcare and tech are two very attractive sectors. Healthcare for its stickiness and growth, and tech for its significant growth. But more importantly, we were looking for a management team that understood what they needed to do from a ride-shoring basis, from a transition to a digital overlay basis, and from a growth basis. And so I met Sudhir in 2015, and he had a vision, and we had a point of view. And luckily, both the vision and the point of view were in sync. And we came together sort of towards the latter half of that year of 2015, and then it took us a year to find the right assets. There are a lot of small, subscale, orphaned assets in the BPO sector, in the voice BPO sector in the US, that don't have these characteristics. Either they're not in the right sectors, they don't have growth engines, they don't have digital overlays. And through our former Goldman colleagues and their networks, we found an asset that ticked most of the right boxes. Except that the business was, at that point in time when we bought it, was a loss-making business, which again was surprising in this sector. And I think we liked what we saw in terms of the putty that we had to work with to refashion the business. And then Sudhir put a fabulous team below him, and he went to work. And as he will tell you his story, we actually took the business down. We shrunk the business first before we began to grow it, because we said that there are certain business streams that were not profitable and were not attractive. So we shrunk the business down, we right-sized the business, and then we put the growth engines in the business as also all the strategies to enhance margins. And it's been a fabulous journey. We right-shored the business. We still have roughly 50% of our manpower, a little more, still in the US, because that was an important part of our proposition. Because in certain sectors, especially in healthcare, having a significant US presence is an imperative. And therefore, how to get the balance on right-shoring right was a huge focus for Sudhir. And then we got those elements right, and we are currently in the US, we're in Guatemala, we're in the Philippines, we're in Malaysia. And I think that journey of managed growth, appropriate growth, and then the incremental add-ons in terms of sectors we were not present, the digital overlay from all the things that our acquisition in Malaysia does, incremental sectors that we attack through TrueSource. So I think what we've assembled over the last 4 years has been, a pretty good combination of a business that has all engines firing from a sector perspective, as well as management teams that are driving the business forward at a very rapid clip.
So before I go into the C3 acquisition in the US and the other acquisitions that Everise has made, Atul, I just want to sort of come back to you to talk about Everstone's platform approach, where you sort of buy into companies early, and then you have this whole strategy of building out the companies, and you have done that across several sectors. And will that continue to be your strategy, where if you identify a very interesting sector or a company, go in, buy it out, and then help them expand into a global entity?
The answer is yes. The answer is yes, Joji. And partly because there is massive fragmentation across a variety of sectors. We've actually executed this strategy now 3 times over. Once with Everise, now where we bought the core, which was C3 Communications, and then did a bunch of add-ons and tuck-ins. We did a whole consolidation play in a company based in India called Ascent Pharmacy, which is in the both pharmaceutical distribution space, and then in the B2C, it's India's largest online pharmacy. We made 12 acquisitions over a course of 3 years there, and continue to build that business organically and inorganically. And the third is a medical device distribution business that we bought into Malaysia. And then we've done 4 more acquisitions. We've added a business in Singapore, business in Indonesia. We've added a business in India, and we're likely to do a couple of more acquisitions to get it to the size that we want it to be, both in terms of revenues and profitability, before we and squeeze out all the synergies before we look to exit that business. I will say though, buys and builds in the Western world are a lot easier because that market is used to acquisitions all the time. Buys and builds in Asia just takes an enormous amount of effort. And but in both Ascent's case as well as in Everlife's case, I think the fruits of our labor are there to be picked, but it is backbreaking work. So relative to the acquisition buy and build strategies in the US, it is hardcore work, but that's, I guess, what our LPs look to us to do. If it was easy, they would do it themselves, or they won't pay us the money they do to do it.
Yeah. Sudhir, just continuing the same thing. At Everise, we've had a acquisitions strategy and a partnership strategy. C3 was a big acquisition in the sense that 8,000 employees, US headquartered. Media reports that the deal was about 150 million. Just take us through, and then after that, you've gone and did several other acquisitions. You bought out Hyperlab in Malaysia. Then you did True Source Labs again, based in the US. You have partnerships with Korea's major BPO, Ubase. Just take us through your whole acquisitions partnership strategy in growing Everise.
Sure, Joji. M&A is a very critical part, really, of what I've done over the last 15 years, right? I mean, between my last organization and my own company now, I've done over 22 acquisitions. And the first thing, the first philosophy that I've always had about M&A is you buy a company for a couple of reasons. One, you buy to acquire capability, which is extremely important. Second, you buy a company to enter a geography, to increase your presence. And sometimes the third, you actually buy a company just to get a great team, and add on to your bouquet of services. As Atul said, in 2016, believe it or not, Joji, we probably had the maximum number of deals that came in this space. And having been in this space for over 21 years now, I was very, very clear on the kind of company I wanted to buy. I always believed that you got to, if you want to create value, you have to do something that is different and it's ahead of the curve, right? So we wanted to build a next gen company. Today it's easy to sit back and say, yeah, we did it, but at that point it wasn't easy because we didn't want to buy a company that was playing in the commodity space, and I've got nothing against that, right? I'd moved to Singapore. I was very clear it had to be US focused. I didn't want to do much, work in other countries, which I was very clear on, which were lower margin businesses, right? And then we came across this great asset, C3, which truly had a remarkable book of business, but it was purely managed. So we took that business, and that was a great platform. Again, my business is no different from the way Atul and his creates platforms. I wanted a platform on the basis of which I could grow and launch. And that happened in 3 phases. The first phase was really the turnaround phase, where we took a $176 million company, which was losing money, to become profitable. The second phase was the transform phase, And in the transformation phase, one, we augmented the best leadership team that we could. And I truly believe I'm extremely lucky with the kind of people that work with us, and we see that on all ratings, that truly people love to work here. And then we did the acquisitions, as you said. And again, each of the acquisitions that we did was very, very, with a very specific agenda. Two Source Labs got us capability into technology, into the tech space, where we pretty much work with all the unicorns you can think about. Hyperlab got us into the AI and the digital space, where we basically make bots in the world of customer experience. And then, because I could not find a company that services North Asia, we actually did a joint venture, with a very dear friend of mine, who owns an Ubase, and we set up that whole venture. So, and with that, we entered the third phase, which is Thrive, which I truly believe in which we are right now, which is we're seeing this huge growth over the last 16 to 18 months. And I think hopefully we'll continue to see that growth. So I think it was a well thought out strategy that we put in place in the first place, but more importantly, it's execution. And we've been razor sharp focused on that. And I can definitely tell you there will be more acquisitions in time to come.
Okay. When you said there's more acquisitions in time to come, is it related to COVID? Has it created a scenario where there could potentially be several strategic assets that you can pick up on a bargain? So have you gone back to Everstone and said, there are these company ABC, potentially great acquisition targets, so these are the ones that we should be looking at picking up?
We don't, M&A as a function for us is an ongoing function. Like you have HR, like you have operations, like you have sales. We look at deals all the time, right? Has COVID got us access to more deals? Absolutely. But are the deals that we typically buy, even if you see Two Source, if you see Hyperlab, they're basically founder-led deals, right? I like to buy companies from people who have founded those companies, and then they come and play a leadership role in our team. The thing that happens in those deals is it takes time, right? Because there's a whole relation building out there that takes place. So it's not like something that can be done in 30 or 60 days. So to answer your question, have deals popped up because of COVID? Absolutely. But listen, we want to be cautious. We will take our time and we will buy the right asset, right? Obviously at the right price.
Buying the right assets, the whole M&A strategy also requires capital. So how are you placed on that front, in the sense that if there are deals that are a couple of tens or maybe $150 million, how are you placed on the capital front for picking up these assets?
I'm firstly, fortunately, we are profitable. So, we do have a positive, balance sheet, which we can, if need be, run to it. But most importantly, have an amazing partner. Who I think if I go for capital will never say no. So I have never till date worried about capital because I have the fortune of having a great partner, and that's his problem, not mine.
But Atul, you always said.
Right.
Yeah. So, but Atul, you have always said, it's not just capital that you bring to any of your portfolio companies. In the case of Everise, what is it beyond capital that you've been able to give them?
I think it's there's no specific thing, Joji. As companies go through this journey, right from the time of identification of the asset to a disciplined way of looking at what you want to do and how to allocate your capital, to the evolution of the business from what you need, what kind of support you need. From turning this business into, from a negative EBITDA to a positive EBITDA. And then how do you grow that positive EBITDA to a level where the business is today? So I don't think there is any one thing. It's, and what good management teams and good private equity firms do is they feed off each other's capabilities. Now, I'm not going to tell Sudhir what he needs to do in terms of recruitment policies. But when it comes to, setting the strategic direction of the business, what is it that we want? In every investment that you make, you must have a game plan. because remember, these are all time-bound investments that every private equity firm must, churn these investments on to the next phase. So you must have a game plan to say, if you start at stage A and you end at stage B, then what does B look like? And then what do we need to do to get to from stage A to B? And therefore, our job is to be Sudhir's partner in the thinking through of these strategies, and then empowering him with a toolkit that that helps him to get where he wants to. And like I said, for different companies, it's different things. We have an Everstone operating playbook where we write down the journey of a business. It's a how-to manual. So everybody says, listen, on an Excel spreadsheet, I start at 100, I need to be 200. I start with 8% EBITDA margin, I need to be at 14% EBITDA margin. Whilst that's great, how do you get from 100 to 200? What are the stress points that you need to worry about? How do you improve your margins? What are the things you need to have in terms of capabilities, either organically, inorganically, from a team perspective? And our job is to be the foil for Sudhir's execution capabilities to say, have you thought of this, and have you thought of this, and what else can we be doing to ensure that we embed that capability or that tool from the toolkit in the company's journey. So that's our job. And then, Sudhir and any partner, it's not Sudhir, any of the partners that we have, their job is to take all that from us and then turn it into an execution game. So that's the symbiotic relationship between capital and talent.
And Joji, the only point I would add to that, I don't think it's just pure capital. There are other ways to raise capital. Capital is not the only thing that my partner gets on the table. I think it's one, for someone like me who this is my first gig, right? I started as an entrepreneur, to really learn. And I've been so fortunate that the entire Everstone team, we actually sit in the same office, right? I mean, there are no walls. I've had the opportunity, if I want to go learn, how do they manage an F&B business, or how do they manage a healthcare business? I have access to all of anything, right? And it's all one big family. And again, for people who are looking at, finding a private equity partner, I think that's what they get on the table. And listen, C3 deal would have never happened, honestly speaking, even though I knew the guys, but the whole, Goldman connection that made the deal happen. And then how do you review the eye for detail? I say this very openly, what I've learned. So listen, it's truly a partnership. It's not one, thing that they get on board. And, I think it's a great journey.
So Atul, where is this partnership headed? Because you talked about a game plan. So what's the bigger game plan for Everise? Is it, because as a private equity firm, you can't hold on to your investments forever. So are you looking at an IPO? Are you looking at a strategic sale? Or will it be like create a much bigger platform before you sort of take a call? Where are you headed?
Yeah, listen, this is this is always the tricky thing, right? When you have a good thing going, why disrupt it? Because it has all the legs to fire and continues to grow. And and this is a business that we think has significant legs to continue to grow and double easily over the next sort of 4 years. I think it's been a great, but we're also in the business of buying and selling companies. So I think what Sudhir and his team have pulled off has not gone unnoticed. And we are in the process of reviewing, what do we do next? Because there's been a lot of inbound interest for people who want to take a look and potentially acquire the business and take it to its next level. If I had the liberty of permanent capital, I would probably hold on to this. You typically each business generally has a 4 to 5 year journey, and so we're well advanced in that journey. So I think suffice to say we're busy sort of scratching our heads and putting our heads together and saying that what is the next leg, because the acquisition trail continues. There's enough opportunity for you to buy. The organic growth opportunity continues. So how should we play the next leg? We haven't come to a decision yet, Joji, but we're getting there. I think by the end of this year we would have our views crystallized in terms of what the next leg of this business looks like.
Sure. You mentioned about a lot of inbound interest. So are we looking at a $400 to $500 million deal here if a deal happens?
Listen, I would not like to comment on that. I think this business it's a great business. It's one of the few businesses that are based in this part of the world that have the scale, size, sectoral exposure with a fabulous management team. So listen, I think time will tell. Once we have something, Joji, I will come back to you and tell you ahead of the others exactly where we stand. How about that?
Yeah, good, good. Sudhir, so let me put that put that number across to you differently. In the past, you've said that you want to become a $500 million company by 2022. We are 2 years from the target, and you also pointed out 2 years from the time frame, and you also talked about how the whole the pandemic phase you had an acceleration in terms of growth. So, do you sort of see yourself hitting that target of reaching a $500 million earlier, maybe like by next year or something like that, or is it still on for 2022?
Good question. Again, let me first just clarify that statement. For me, I am not obsessed with revenue. I really, when I say I want to be a $500 million company, I look at more from a value point of view, right? And the value that I can create for my partners and my shareholders. So that's just a disclaimer. Uh, uh, as you spoke about the pandemic, this year there are actually companies have shrunk from minus 20% to few companies that have grown at about 10 to 12%. We will grow at over 25% this year. At least that's the way we are growing. I think if we keep the track record that we have demonstrated, I think we will be a $500 million company by early next year. So I think it's going to be earlier than what we have projected. I am now working on my new blueprint, which is how by 2024 can we be $1 billion company.
So I'd assume to hit $1 billion, you would be looking at a lot more acquisitions and partnerships. So in that context, just want to know, how do you sort of integrate, one key thing with getting acquisitions right is integrating multiple different teams across different geographies. And it's often a very delicate balance, bringing in senior leadership, sort of ensuring that you balance everybody's interests. How have you handled that across all the companies that you've bought?
That's a very, very good question. I think people underestimate that acquisitions fail not because that you did not identify the right company or you didn't buy the right company. It actually fails because you did not integrate it well. Fortunately, even before I started this journey, I had done 19 acquisitions and I made my fair share of learnings and mistakes, right? So we are very, very clear. We have a toolkit. Actually, it's a playbook, the way we integrate companies. So, and in that playbook, just to let you know, from start to end, we integrate a company in 100 days, irrespective of the size and the scale. And and there is something that happens pretty much every month, and in the end of 3 months, the companies get integrated. Now, integration doesn't just mean that you've changed people's email ID, and it's not that, right? It basically means that, let's say, on the HR side, they come onto our platform, which is Workday. On the finance side, they come to our platform, which is NetSuite. Basically, anything and everything gets completely integrated. You said about the leadership team, which is extremely important. During the acquisition process, we actually sit with the teams, with the leader, with the founders, and openly draw what the org chart will be day one the company gets bought. Also, we are very open that there are certain key roles that we don't need. We are very open about it, and we say, let's do a nice golden handshake, and we let them go. And it's because we don't want to have duplication of roles. So listen, that's how we integrate companies. Also, we never buy a company till the time the earlier acquisition is complete. So we are very, very clear. We buy a company, we integrate it completely, and then we go on to buying another company. So if you see it, we did 2 acquisitions in 2018, and pretty much the entire 2019, we did not do anything.
Got it. Atul, from your end, you also earlier talked about having a playbook and a toolkit in terms of buying companies, platform approach, building them up. in that whole toolkit, where does layoffs come? When you sort of acquire companies, at some point, I think you may have to let some of the people in the companies that you acquired go. And the bigger question on layoffs is, especially in these times, in times like this, I'm assuming a lot of your portfolio companies, or at least some of them in certain sectors, may have had to let some of their staff go. So, in your playbook, how do you handle something like this?
Yeah, look, this is a tricky one where I think if you have a surgical approach, so if you're buying businesses where you find that certain leadership roles are either not needed or people are not growing to their capability, that's an easier approach because you're dealing with, I guess, white collar people who you can have an intelligent, rational conversation with. Where it gets trickier is where the numbers get large. And I would say this, that through the pandemic, thankfully we haven't had to deal with too much of that. Now the F&B businesses are large employers of people where the businesses themselves have been shut. And we've been, I think it's very hard to build teams and very easy to sort of break teams. And we've been very cognizant of that, Joji. So our first approach has been keep the teams together. Now, in any business, what happens is there's always attrition. People leave, people get married, people don't want to work, they find other jobs. And so businesses are always backfilling attrition, and no different than what we've had in Everise. So I think what we've done in order to just right size businesses that for whatever reason have had to slim down during this pandemic, we've managed the backfill of the attrition sensibly. And that has been a big determinant of getting the businesses right sized. But I think in times like this, you also have to have a reasonably humane approach. If you're letting someone go, you have to work with that someone to properly outplace them, because this is not a great time for people to find jobs. So I think there's no one approach. There's a combination of everything. But I will say, just looking at the portfolio as a whole, I think we've been very fortunate that we haven't had to face these really tough decisions on what to do with a mass of players, a mass of workers that we haven't been able to afford. So I would say we've lucked out.
Got it. Also, has the whole COVID situation, the pandemic, opened up more opportunities for a private equity firm like you, because you're across different continents, different sectors? Are there any new sectors or new businesses that perhaps you may not have looked at earlier, but it's sort of interested you, or you think is the future going forward?
I think trends have accelerated, Joji. I don't think there are new sectors being discovered. I just think, someone was giving me the stat that pre-COVID, 16% of e-commerce in the US, 16% of all retail in the US was e-commerce. It's approaching 30%, which people thought would happen over 10 years, and it's accelerated into 5 months. So I don't think new business models have emerged that much. It's just that trends have accelerated. So if you look at our fund three, we are very heavily biased. 81% of the allocation of capital is in two sectors: IT services and healthcare. And I think I wouldn't say that we had anything of what was to happen with the pandemic, but I think both those sectors have been huge beneficiaries because of the pandemic. And I think as we look forward, we think we will continue to allocate capital along those vectors. And I think then within those vectors, there are things that are growing faster. So, transition to digital, which used to be, till I would say the end of last year, companies would have a choice in terms of allocating budgets of how much money they wanted to put in order to transition their business, wherever that business was, into a digital domain. I just don't think that's a choice. I think the question is not, people are asking themselves, how much money do I have to spend and how quickly can I get into a digital domain, rather than do I need to do this? So, and therefore businesses that are going to have outsized gains from that. So companies that did not require customer service in it. Now, if you are in the digital domain, you require customer service then. People can't walk into your stores or can't walk into your offices to get their customer service needs fulfilled. So I think what we're doing is we're looking at all these trends and sort of doubling down on what we think are going to be winners over the next 5 years, because you can only take sort of, a 5-year point of view at this point in time. So I think sectorally, we will continue to focus healthcare, healthcare and IT services. And within that, we will find things that we think have accelerated sort of tailwinds, if you will, that get them to outpace the market or outpace their competitor set. So that's our job as we look forward into kind of the 2025 vintage of investments.
Got it. And Sudhir, in your sector, what are the trends that you're seeing which are sort of being accelerated by the pandemic? Is it possible that, when you started, for example, voice was over 95% of your business used to be voice driven. I understand it's about 75% now. Do you see a scenario, or when do you sort of see this hitting, let's say, maybe 50%? Is that even possible? Well, voice just accounts for 50%.
Joji, firstly, let me tell you, our industry, even though we are in the tech industry, has never ever seen a disruption like the way COVID has shown. Okay. And I think this industry has changed forever. I think companies have woken up and they've realized, oh my God, are we doing too much of the same thing with same company? How is the people's, as Atul said, how is our partners' digital strategy? I remember till about 3 years back when I used to go with my sales guys and I used to ask, I want to sell bots, right? They used to say, please go to CTO, because anything to do with technology was a CTO discussion. Today, whether you're a chief people officer, whether you're a chief operating officer, whether you're a chief financial officer, digital and technology is a part of your agenda. You have to know technology. So that's a big thing. Okay. And listen, change has happened. We have seen our order book grow by 30% in the last 5 to 6 months. Okay. Just a correction. We are close to, when we bought C3, it was 95% on purely voice. Today, we are closer to 70%. Phone is a very important part of what we do. Let's be very clear. At the end of the day, when a customer wants the problem to be solved, no one wakes up and says, hey, let's call someone. We actually do stuff on one side to help people, and on the healthcare side to actually save people's lives, right? That's what we do. And you can use technology to a point, but you can never take away the human brain. If you to answer your last point, do I see it? So again, it's been a big, from 95 to 70% is a big shift. I think it probably land up at about 55 to 60% over the next 2 to 3 years. And I think that's when it's going to stabilize.
Sure. Atul, I just want to, we have about only 15 minutes left. I just want to come back to you on a couple of quick questions on Everstone. Some of it is even from our audience. Just want to understand, what is the status of Fund 4? You were supposed to, if I'm not mistaken, you're supposed to launch Fund 4 this year.
I think Atul has just stepped out. Maybe you can ask me another question. You can ask that.
Sure, absolutely. Yeah. Okay, Sudhir, coming back to you. One of the audience questions that we've got is, what, like, for the BPO sector as such, what is it that has really changed, in the sense of, when you ask a consumer, when it comes to consumer complaints, they still have the same, they still have the same complaints for the whole BPO sector. So what is it that in, like, for example, at Everise, what is it that you're really doing differently compared to a whole set of other BPOs that are out there?
So listen, as I said before, no one calls a BPO or emails or chat if they don't have a problem. Okay. And I'm gonna answer that question with a small example that I always give. I think every company is a good company, but there are few great companies. And what defines the difference between a great company and a good company is nothing else but customer experience. And I'll give you 2 examples. Number one, I live in Singapore. I'm biased. Singapore Airline is the best airline in the world by far. But why are they different? Because the planes they use is still the A350, the 777, the A380, the A320. It all boils down to the service and the customer experience. Second, let's take Apple. It took Microsoft 10 years to realize that they also need to have a store on Fifth Avenue in New York. Once you're an Apple junkie, you're an Apple junkie, and they do charge, for their products, and people pay for it. Why would you stay at a Four Seasons anywhere in the world compared to a Hilton? They could be next door. By the way, the building is almost the same, right? And you pay 3 times more because of the service. We partner with those companies that want to be great companies. That's what Everise does. And we provide great customer experience irrespective of which channel it is served from. So it could be voice, it could be email, it could be chat. We don't care. Okay. But we want to deliver the best customer experience for the best companies that are out there so that we can create fans out of their customers.
Sure. Atul, I'm just coming back to you because we have only about 10 minutes left. Some quick questions. Some of it is from the audience on Everstone specifically. Status of Fund 4. Let me start with that.
Well, we are putting our plans together to go raise Fund 4. We're almost done with investing capital out of Fund 3. We have a little more firepower to go, and I think towards the latter part of this year, we'll be out talking with our investors about raising incremental pools of capital.
Will it be $1 billion fund, Fund 4?
I have, that only my LPs can tell me. But yes, I think our given what's happening, look, the reality is that investment sizes are increasing, and bigger checks in more mature companies are just, in our view, are better risk reward. Because businesses are more mature, they have better management teams, and you have more runways to do things with. So that, and number two, the reality is that this region still grows despite, on a normalized basis, sort of 6% real and 9-10% on a nominal basis. So as economies compound, we started investing in India India specifically when the GDP was 1.6 trillion. It's now 3. You take 2020 out and pencil in kind of like I said, 9%, 10% nominal GDP growth. Size of businesses keep on increasing, and therefore what we do in terms of buying those businesses, those sizes also keep on increasing. So I think, we would like to increase. The last fund was about $730 million in size. We will, through our co-investor, put in $1 billion of capital. So, that's about the range that I think we'll go out with.
Got it. And on the private credit space, because you've always looked at it as a huge opportunity, again, you're supposed to do a dedicated fund for that space. Is that happening?
Yes. As you know, we have through Fund 2, a non-banking finance company called IndoStar, and that's been a very successful investment for us. And as we look at the massive disruption in the credit sector in India, we think that that sector requires a significant sort of capital solution. So we are well on our way to structure vehicles to enable us to exploit that opportunity. We have our teams ready to go, and we are deep in conversations with people on that strategy, Joji. So
and any fund size or targets?
I think we will probably have a better idea towards the latter part of the year. And again, once we get that capital locked down, we'll be out communicating with the wider audience as to how much money we have and what we'll be looking for specifically.
Sure. I'm taking a question from Randy now, as we sort of, this is both for both of you, both for Atul and Sudhir. He wants to know, with the trend of SPACs in the US, in the sense that the kind of listings that we are seeing, do you see this method of sort of coming to Asia where private companies can sort of go public through this form of listing? It's not really happened in this part of the world, but we've seen a lot of examples in the US.
Yeah, no, I think, I think the domicile for the vehicles will continue to be the US, Joji, because I think that market understands the whole mechanism of raising capital from a SPAC, or via a SPAC, and then the de-SPACing process of listing the resulting entity that gets acquired. So I think that it's unlikely that other markets around the world will have an investing infrastructure that lets SPACs come in anywhere outside the US. But as you know, there is a great amount of flexibility for those SPACs to acquire businesses, and those businesses may be acquired anywhere around the world. So will SPACs be a yet another capital solution, either for owners of businesses or private equity to exit out? Absolutely. And I think historically, most of the SPACs in the US, and I am generalizing here, have bought US businesses, partly because, you know, businesses in Asia haven't been able to get that size. But I think that's changing. So I will not be surprised if you see SPACs where capital is raised in the US, but those SPACs are used to acquire businesses in different parts of Asia. I think that trend is on its way.
Sudhir, you have a large US operations, large US presence. Have you thought about this option for Everise?
Listen, again, Atul and I, and we keep discussing multiple options. As Atul said, again, I think especially for a SPAC, it will be the US, because I think they understand it way better than any other countries. And will other markets open up? Probably yes, but I don't think anything in the near future. Specifically for us, we are still evaluating options, as Atul said, and our strategy will be clear by the end of the year on which route we take.
Okay. Atul, another audience question for you is, do you see Everstone, especially in these times, getting into special situations investing in India or Southeast Asia or even in other locations?
I'm not sure what special situations means. Listen, there are many different ways to play, right? You can play through our, I think we are providers of capital solutions, Joji. You can call it by any name you want, whether it's a recapitalizing business. If you look at the private equity strategy that we have, that is a control growth oriented strategy where we like to own majority of the businesses that we own and help management teams drive the goals that we set out as far as the investments are concerned. The debt businesses are pure debt businesses. The credit business is a pure credit business. I think what we don't want to do is be a minority investor and merely provide a capital solution to a company that may be in trouble. That's not our business, so I don't think we will venture down that path. Our capital provisioning in the credit side will be on the debt side of the balance sheet, and that may or may not be, you may or may not extend the definition of the special sits to say that's covered. But on the equity side, it has to be a control-oriented play. Otherwise, it's hard for us to get excited to do what we do.
Got it. I'll take one more question this is from Dawal Jain, and this is to Atul. His question is, what's the value of information for a PE fund, considering the travel restrictions in these times where it's not possible to go and meet people or do physical inspections? In these cases, how do you sort of do DD and handle deal making? How do you sort of rely on the information that is just sent across on a call or on emails or something? How do you go about it?
Great question. And I think it's tough. And, it's been, especially when, that has not been the mode of operation. Now, in a year's time, if the world continues to be where it is, people will have to be inventive in figuring out, how they're going to manage the risk of buying businesses where they can't meet management teams and can't go see facilities. But I think it's, as we sit here today, it's tough. And unless potential buyers meet with management teams and figure out, it's less to do with, visiting factories. It's more to do trying to understand how management teams are driving the businesses forward. And more importantly, people work with people, Joji. You don't buy a company for what it is. You buy a company for the way it's managed, and it's likely to be managed on a go-forward basis. And you need to have a call on the business, but a call more on people. So I think that is going to be tough to pull off. We just completed a transaction last week. We bought an IT services business in the US, but work on that had begun way before COVID. It had begun last quarter of last year. So we'd done all the management meetings, and we had all the qualitative stuff done, and then the quantitative stuff followed during the lockdown period. But if you don't have the qualitative assessment on capabilities and people, I just think it's going to be difficult. Now, if this carries on, like I said, in August of next year, if you ask me, necessity is the mother of all of invention, right? So we'll have to figure out a way to manage this, using technology, but we're not there yet. Fortunately speaking, we're not there yet.
Good. Closing comments. Sudhir, you want to go first in terms of, because we've already hit our 1 hour deadline. 12 months from now, where do you see Everise?
Really, I think 12 months from now, I would probably like to see that, we do at least 2 more acquisitions. Okay. Probably add, I think, close to 125 to 150 million dollars to our top line, and try work towards the plan of being $1 billion company. I mean, now that we put that goal for ourselves, it's a audacious goal, but now we got to get tracking on that. My last point is, we as people keep reinventing ourselves the way we work, right? The reality is a lot of deals that are today, even in our M&A pipeline, we've already interacted with those people. I think what's going to be really interesting is to see how do you do a deal if you haven't met the people, right? And that's the scary unknown, which unfortunately I don't have an answer for. So hopefully this time will pass pretty soon, and we can get on with our M&A engine. But other than that, listen, hopefully our teams are going to keep doing the great job that they do, and they're going to keep growing organically as well.
Yeah. And Atul, from your end,
execution, Joji, it's all the execution. You just keep cranking on.
Yeah. Good. And Atul, from your end, 12 months from now, what about Everstone? Is it going to be, you'll be in the process of raising fund for, in the process of raising your private credit fund? You're also in the, you also have real estate funds, you have a renewable energy fund. So it's going to be like, do you see next 12 months full steam like fundraising along with execution, or will something else change, or investment thesis change because of the situation right now?
No, I don't think the investment thesis has changed. On the real estate side, we are huge beneficiaries of the switch to e-commerce. And, because of our warehousing businesses, we're seeing unprecedented demand from players in the e-commerce world who are desperate to get to scale their businesses, even at a faster clip. On the renewable energy side, we're partners with British Petroleum. We continue, and given all that's going on with climate change and the government's in India propagating use of alternative energy, we continue to see massive momentum in that business in terms of building out our portfolios and our platforms. Credit, I think we are, like I said, we're in the process of raising capital for that. By the end of this year, I think we'll be done. We will be in a deploying mode over the next, over the next 12 to 18 months in that strategy. So, different asset classes are in different stages of capital raising and deployment, and they are asynchronous. So somewhere we're deploying, somewhere we're raising. And so that cycle will continue, Joji. So yes, we'll be out raising capital for Fund 4 in the next 12 months. And at the same time, rustling up enough demand and hunting for deals. So the treadmill never stops. So, unfortunately, we're in a business where you have to run to stand still.
Sure. Thank you, Sudhir. Thank you, Atul. We've run out of time. We still have a couple of more questions that we can't take, but I will get them sent across to both of you. And thank you all for joining in. Give us a day or two early next week. We'll send across the entire transcript and the video to all of you. So thank you once again, and hope to see all the DealStreetAsia readers. We hope to see you for our next webinar, which will be sometime in the month of September. Thank you. Have a great evening.
Yeah. Thank you, Joji.
Thanks, Joji.
Thank you, Joji. Thank you for having us on your show.
Yes.
Take care.
Thank you.
Thank you. Bye-bye.